Hello and welcome to Live Wire Markets and our series of short, snappy ideas, The Pitch. I'm Huntsley. Thanks very much for joining us. Our subject today is a Live Wire reader favourite, small caps. But what is the secret to finding the best of the best in this space? Well, joining me to answer that question and others is Michael Poulsen, co-founder and portfolio manager at Canopy Investors. Welcome, Michael. Good to have you with us.
Thanks for having me.
So you invest in global, small and mid-cap stocks. They are still trading at a historical discount to their large-cap peers, despite a recent run of outperformance. So do you see the reversion continuing?
So you're right, global small and mid-cap stocks have performed pretty well in the last couple of months, particularly in the US. I'd just clarify that that's not necessarily just a recent phenomenon though. There's data going back to the 1920s in the US, for example, that shows small caps outperforming larger companies. So we really see the last couple of months as a continuation of that longer term trend. Now, as we sit here today, smaller companies are trading at about a 15% discount to larger companies on a price to earnings basis. And for context, that's about the largest discount that we've seen in about 20 years. So it's pretty significant. We do think it's reasonable to expect that valuation gap to close some over time, particularly if US economic growth continues to be good, which it has been, and if interest rates come down a little bit from where they are today.
Okay, excellent. So as somebody who looks at this space closely, I'm going to ask you the magical question. What's the secret sauce to finding the best of the best?
Thanks.
And I guess as well, what factors are you looking out for?
So we're quality investors at Canopy, so we're investing in good businesses. And so that means companies that have sustainable competitive advantages, companies that are growing and that have managers that are capable and think like long-term business owners. So in the context of global small and mid-cap, what that means is they're smaller companies, so it's not your Amazons and Microsofts of the world, but they're still really strong. So they'll often have a dominant position, but maybe in a single geography, or they might be really, really strong in a particular business niche. And often those niches aren't represented in Australian industries. And so that's part of the reason why we wanted to do this, is to give people an exposure to industries that they wouldn't be able to as an investor very easily in Australia.
Sometimes when I talk to quality investors, there's this reconciliation that's got to be done between, high quality and valuation, right? And most of the time the market's worked out as something is high quality enough, and there's a valuation premium in that. How do you reconcile between quality and valuation? And do you accept that you're going to have to pay just a little bit more?
Of course, yeah. That's very often the case, and that's one of the hardest things being a quality investor, particularly when, as you said, the companies, it's recognised that they're quality. So for us, that means that we're fishing in a pond of good businesses. That just has to be the case. That's our starting criteria. But then once we've crossed that gating factor, it's really looking for those companies where we think that they are fairly to attractively priced. Often that's the case where they might be having some short-term weakness that's been over-extrapolated, but that's a key criteria.
I note that the fund is heavily weighted towards the US. Why is that?
So the thing to recognize is the US is the largest single country in our opportunity set. It would be 60 to 70% of our index. It's obviously the largest economy in the world, and it's a very advantaged economy. So it's got a great diversity of businesses, obviously a large consumer base. It's technologically sophisticated, endowed in natural resources. You've got the dominance of the US dollar, and you've got a government that's very willing to spend, so large fiscal deficits. And what that means is that there's lots of good companies there, many that have tailwinds, and we found lots that we'd like to invest in. Now, that being said, as I mentioned at the top, the US market has run pretty hard in the last couple of months. And so as a consequence of that, we are finding opportunities outside the US of things that might have been thrown out when they really shouldn't have been.
I guess we'll get the viewers and the readers to get their pen and paper out now, because it's time to put you to work, sir. Can you take us through 3 global companies you are backing for the year ahead, and why?
Yep, happy to. So the first one that I'd mention is Corpay. So this is a US-based financial services company. The largest business that it has is fleet payments. So you can think of this as fuel cards effectively. So it might be a trucking company that gives a fuel card to their drivers, which enables them to buy fuel when they're out on the road, but only fuel, so tight spending controls. It's a pretty good business. It's relatively mature, but the bit that we're more excited about is it has a corporate payments business. And think of that as helping businesses pay for their expenses, and that's growing really quickly. So that's on track to be Corpay's largest business within the next couple of years. We expect that corporate payments business to lead to an acceleration in Corpay's growth over the course of the next 12 months, and its valuation is pretty attractive considering that. So the second one that I'd mention is Rollins. That's a US-based pest control company. So you think of that as the guys that come around in a van to your house and spray for pests. It's relatively unglamorous, but it's actually a really good industry. We're living in more dense urban environments and pests are proliferating. The climate's getting warmer, pests like that as well. So it's a good business, lots of jobs going. It's a network density business as well. So that means that the pest control company that's the biggest and has the most jobs on the go is best able to utilize their technicians and is more profitable. And Rollins is that big guy. Its growth is accelerating, and we expect that to continue to be the case over the next 12 months. And the last one that I would mention is Rightmove. It's a UK-based property portal, so it would be the equivalent of REA in Australia, but in the UK. And you might have read that REA recently tried to acquire it. So look, it's super dominant. Agents have to be subscribers to Rightmove in order to get their listings up on the site, which of course the people selling the property, the vendors want them to have their properties there. So it's got 80 to 90% market share as a result. Lots of pricing power as well. In fact, that's one of the pushbacks that you hear from real estate agents is Rightmove's always increasing its prices. But if you ask an agent if they'd consider pulling back from the site, they'll tell you it would be like a shop owner not having a front door on their shop or something. So it's a really important channel for them. Now, it's a subscription-based business, so it's not super sensitive to property market conditions, but we do expect the UK property market to improve over the course of the next 12 months, which should be a tailwind.
Corporate payments, housing, and pest control. That's the kind of variety you get at Livewire Markets, everybody. Hey, it's been great to chat, Michael. Thank you so much for joining us.
Thanks for having me.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where we are adding great content every single week. Till we see you next, take care.